You have the football sponsorship of the soccer team, the football team from Munich as well. We see the sponsorship of sports. What's the value to Allianz, the payoff of Bayern Munich?
Oh, it's hugely positive because that's the best brand in sports, at least in our country. And we've been associated with it for many, many years. I'm very, very proud of it.
Now you have a bond bear market. Some would say your best brand and acquisition was the Gross-Alarian Combine of Pacific Investment Management Company years ago. Give us an update on bond asset management and the view forward given this great bond bear market.
Well, the current circumstances are tough, but it's very good to be with the best company in these environments, right? So we see a flight to quality over time. People are watching, but because we have a very, very long duration business model, we look forward. We believe it's going to be fantastic for Pimco and us over the next few years as the interest rates stabilize. Because the money will come back into bonds, and think about accumulation at the interest rates that we have. People often don't run a simple NPV model and say, what does it mean if you reinvest at 5% or 4.75 rather than 0?
You buried an important line there. It was in there, but it was buried. When interest rates stabilise, they're not stable. What did you make of what happened in the gilt market in the last couple of weeks? What are the lessons you've learned from that?
The first one is if you have a political idea that it's not anchored in economics, it's very dangerous, particularly if you're not the world reserve currency like the US dollar. We have learned that, number one, Brexit now will start to pay the price, and you see that. And the second thing is that markets have become to dominate again. We're coming out of 15 years of quantitative easing, no price for risk, nothing, no fiscal discipline, no monetary discipline, and suddenly that's back, and people have to get used to the fact that the laws of physics hold again, even for governments.
Well, and we were talking about how this gives room and gives rise, once again, to bond vigilantes.
Yes.
Are you the bond vigilantes? Do you actually actively go through some of the policies and say, not going to buy this company, not going to buy this nation because of what they're doing?
I wouldn't be thinking about negative selection because that's not what we should talk about, but we're looking at countries and companies that properly manage. You know, if you have a dual deficit, think about that. 3 years ago, we had 3 times the financial stimulus in the United Kingdom that we saw a few days ago. Nothing happened in the markets, right? Nothing happened. Everybody was sleeping. And then suddenly people wake up to the fact that what has been done is really a disaster, and suddenly the prices are coming. Why is that? Because of inflation, people have started to reprice assets fundamentally, not just bonds. And by the way, we are not even at the midpoint of repricing of assets. We've just seen the liquid assets reprice. The rest will come now.
When you said actively selecting specific companies, specific nations, this speaks to the active selection that so many different fund managers talk about now as really reigning supreme. Where does that leave passive management?
It's really interesting. So it is different between equity markets. If you have large cap equity, you can invest in them very effectively through index. If you're in the bond market and you don't know where things are going, you better be with the people that know what is happening and can differentiate. It's a great proof point. So I hope that all our colleagues are proving themselves now.
I'd like to repeat something you said moments ago. The liquid markets have repriced, the illiquid markets haven't yet.
Yeah.
What's that going to look like? We've spent a long time talking about pulling back the veil on some of the carnage that might take place because of 10 years worth of zero interest rates. And what we get told is that in public markets and credit, balance sheets are strong, the resilience is there, the maturity walls is way out on the horizon, not coming soon. What's going to happen in private markets?
I'm not a great investor, so let's just start. I'm trying to be a good risk manager, which is very hard. But it's very hard to see it, and therefore it doesn't mean it doesn't exist. So people have to face a lot of scrutiny now on how the funding is. So watch out more, not just leverage, but liquidity. I think, and we saw that in the gilt market, people do underestimate liquidity traps, and that's something that we need to look for. And you see that in private equity when people look where are earnings really coming from. Are they trading amongst each other? Are there true exits? What are the funding structures? So it's going to go through real estate, private equity, just slow motion, but it's going to come.
The gravity's back. The risk-free rate is back as well. Talk about conservative money, pension money. Forget about LDI and the gyrations in London. Just normal institutional money. What's the shock going to be as the risk-free rate returns?
So the key thing is really, and that's what we also have to do, think about resilience. right? The point is the shocks will be harder than people anticipate. The diversification is the thing that is never there when you need it the most. So people really need to look at their models and saying, how come the world completely missed out on inflation? I mean, when you think about the fact that in November of last year, we've started to buy inflation-linked bonds a lot of people were still saying, yeah, but in the middle of this was all central banks, even some of our biggest economies. So the question is, why is that happening? And the first answer is, I don't know why, but what I know is we have to de-risk at
So how do you de-risk? You just bring in duration? Do you have to change your actuarial assumptions?
Exactly.
How do you de-risk with adult money?
Yeah, the adult money is basically, yes, if we were, completely in an endowment, you would really selectively take risk. In this environment, we can't, with a AA rating and one of the few places in the world that AA rating, even give the impression that we don't have our tail risk under control.
Given that you're based in Europe right now, how concerned are you about the prospect that the pain that you're experiencing now, both from a business and an investment perspective, is not just going to be this winter, it's also going to be next winter. It's also going to be potentially for years to come if there is not some sort of sustainable energy plan put into effect?
So I have to be a realist, but I'm also a born optimist. Otherwise, I think I couldn't do the job, right? So the first thing is, I think,
Welcome
particularly
to surveillance.
the key thing is that people, I think, have been overselling Germany, if I may say so. So I'll give you an example. We have had demand contraction on gas, 15% already this year. Now, much, for example, Italy has been only 2%. So we will have most likely enough gas to come through the winter. People do not factor that in. Now, the second question is, what will be the implication for industry to reprice its products and its production supply chains to a higher energy price? And that's happening. I really believe in our engineering capabilities, very comparable to Western Switzerland, where everybody said when, the Swiss franc was floated that all the manufacturing companies would die. No, we invest in innovation, will be very good.
Right.
The key thing is, however, we need for Europe to realize now one important thing. Germany needs to really focus on reinventing its business model. It's over with cheap energy from Russia, successful exports to China, and America providing all the security. I mean, that formula is ending. And that will require a lot of energy on the German people to fix its model, which means we have less attention and tolerance for doling out money to other people.